The stock market isn't just about $100 shares or household tech giants. Some of the most compelling and controversial opportunities heading into 2026 are sitting well below $20. These aren't penny stock lottery tickets. They're real companies with real operations, tangible assets, and very specific catalysts that could either unlock value or expose serious weaknesses. Today, we're breaking down 3 stocks under $20, each at a different price level. One under $5, one under $10, and one under $20. Each operates in a different industry, each carries real risk, and each has something happening right now that makes it worth understanding. And make sure you stay until the end, because the third pick on this list is undergoing a major strategic shift that analysts are watching closely, and it could completely change how the market values the company in 2026. Before we begin, a reminder, this is not financial advice. Everything discussed here is for educational purposes only. Always do your own research and never invest money you can't afford to lose. Why look at stocks under $20 in 2026? When people hear cheap stocks, they often think low quality. But price alone doesn't tell the full story. The SEC defines penny stocks as those under $5, which often come with extreme volatility. Stocks between $5 and $20 sit in a different category. These are often companies going through transitions, industries under pressure, business models being rebuilt, or sectors facing macro headwinds. In 2026, markets remain highly selective. Interest rate uncertainty, energy transition policies, competition, and housing affordability are all shaping investor behavior. Large institutions often avoid lower-priced stocks due to mandate restrictions, not necessarily because the businesses lack potential. That's where opportunity and risk can appear. Stocks at these levels can move quickly if sentiment shifts, but they can also fall hard if execution fails. Understanding the why behind the price matters more than the price itself. With that framework in mind, let's look at 3 stocks under $20 worth examining as we move deeper into 2026. Stock number 1, Plug Power. Under $5 ticker, PLUG, price, around $1 to $3. Plug Power operates in the hydrogen fuel cell and clean energy space, focusing on hydrogen production, electrolyzers, and fuel cell systems. The company positions itself as a full-stack hydrogen ecosystem, producing, storing, and delivering hydrogen for industrial and mobility applications. Heading into 2026, hydrogen remains one of the most debated energy technologies. Supporters see it as critical for decarbonizing heavy industry and long-haul transport. Critics argue it remains expensive and inefficient compared to electrification. From a business perspective, Plug Power has made progress, but challenges remain. In 2025, electrolyzer sales became a much larger part of revenue, growing significantly year over year. The company expanded projects in Europe, Africa, and the U.S., and secured contracts with high-profile customers, including government and aerospace-related entities. Policy support remains a key factor. The extension of clean hydrogen tax incentives through the latter half of the decade provides a tailwind heading into 2026. If hydrogen adoption accelerates, Plug is one of the few vertically integrated players positioned to benefit. However, the risks are substantial. Plug Power continues to operate at large losses, with ongoing cash burn and shareholder dilution. The company has repeatedly raised capital, and profitability has been delayed multiple times. Analysts remain divided, with price targets ranging from deeply pessimistic to moderately optimistic. The bull case depends on execution. Scaling electrolyzer deployments, reducing cost, and proving hydrogen can compete economically in targeted applications. The bear case is straightforward: continued losses, dilution, and a slower-than-expected hydrogen rollout. Plug Power is a high-risk, high-uncertainty play that reflects the broader debate around hydrogen itself. Stock number 2, NIO. Under $10 ticker, NIO, price, around $5. NIO is a Chinese electric vehicle manufacturer, operating in the world's largest EV market. Unlike many competitors, NIO differentiates itself with battery swapping technology, allowing drivers to exchange batteries in minutes instead of waiting to charge. By 2026, China's EV market remains intensely competitive. Price wars, rapid model cycles, and government policy shifts have pressured margins across the industry. NIO has responded by expanding its product lineup across multiple price tiers, including more affordable sub-brands. Operationally, NIO has shown improvement. Vehicle deliveries increased significantly year over year, and margins have stabilized despite pricing pressure. Losses have narrowed, and management continues to target break-even over the medium term. The opportunity lies in scale. If NIO can grow deliveries while improving efficiency, its valuation could look disconnected from peers. Analysts see upside potential, but opinions vary widely. Reflecting uncertainty around China's EV landscape, risks remain significant, F price. Competition could intensify further in 2026. Government subsidies are being reduced, potentially impacting demand. Geopolitical tensions add another layer of uncertainty, particularly for companies listed outside China. NIO represents a bet on China's growth and the company's ability to differentiate through technology and brand, a risky but potentially rewarding setup. Stock number 3, Opendoor Technologies. Under $20 ticker, Open, price, around $6. Opendoor is perhaps the most controversial name on today's list. The company operates in digital real estate, originally built around the iBuying model, purchasing homes directly and reselling them. That model struggled badly as interest rates rose. But heading into 2026, Opendoor is no longer the same company it was a few years ago. In late 2025, Opendoor underwent a major leadership and strategy reset. A new CEO with a background in scaling technology platforms took over, while founders reinvested heavily and rejoined the board. The company shifted focus away from aggressive home flipping toward becoming an AI-driven real estate transaction platform. Instead of relying on wide margins and slow inventory turns, Opendoor is prioritizing speed, tighter pricing spreads, and automation. AI tools are being used to price homes more efficiently, reduce operational cost, and accelerate transaction velocity. Financially, revenue declined as the company intentionally reduced inventory, but losses narrowed. Despite weak fundamentals, the stock surged in 2025, driven partly by retail investor enthusiasm and partly by optimism around the turnaround. Analysts remain skeptical. Price targets remain below current trading levels, and many question whether the new model can deliver sustainable profitability. The bull case is compelling but uncertain: stabilizing mortgage rates, improved housing activity, and a successful platform transformation. The bear case is equally strong: continued cash burn, housing market weakness, and an unproven business model. Opendoor is the definition of high risk, high reward, and easily the most volatile stock on this list. Key risks across all three stocks: all three companies share common risks: high volatility and sharp price swings, ongoing losses, and uncertain paths to profitability, sensitivity to macroeconomic conditions, heavy dependence on execution, and external factors. Lower price stocks magnify both upside and downside. These are not set it and forget it investments. Final thoughts: Plug Power, NIO, and Opendoor each represent very different bets heading into 2026. Plug Power is tied to the future of hydrogen and clean energy policy. NIO reflects the intensity and scale of China's EV market. Opendoor is a turnaround story in digital real estate powered by AI. None of these is our safe investment. All carry real risk, but each highlights how opportunity in the stock market doesn't always sit in obvious places. If you found this breakdown helpful, consider subscribing to more deep dive stock analysis. Drop a comment below. Which of these three do you find most interesting, and why? Thanks for watching, and remember, protecting your capital is just as important as growing it.